Why is the average return of the stock market around 8 to 10% per year, while the average investor's returns is only 3 to 4% per year? In this video, I will cover some of the mistakes that I often see investors make. Learn to avoid this and I can guarantee that you will do better than the majority. Investor mistake number 1 is to assume that a stock with a lower price is cheaper. A lot of people are looking for cheap stocks and falsely believe that if a stock is, say, $10 a share, it's cheaper than a stock that costs $100 per share. But to know if a stock is cheap or undervalued, you have to look at the value of the whole company and compare these to the value of all shares. If you still think that the value of all shares is not the same as your perceived value of the company, then the stock might be undervalued. So the price of a share doesn't indicate if this is a good stock to buy or not. A stock with a share price of 10 is not better or worse than a stock with a share price of 100, and they have the same probability to giving you good returns. But then some might object, yeah, but I will get more shares if I buy the one for 10 than the one for 100. At least this must be better. But again, this is not the case either. The only thing that matters for your returns is the amount that you invest into the stock. If you invest 100 and the stock price rises with 10%, then your shares are worth 110. It doesn't matter if you bought 10 shares for 10 apiece or 1 share for 100. The same amount invested will give you the same return if the stock price increases with the same percentage. Mistake number 2 is to buy stocks based on feelings or based on others' analysis. A lot of people are buying stock just based on feelings, and even more experienced investors do this. People buy stocks based on feelings that the stock surely must rise now, without doing any analysis about the future potential of the company. Apart from this, many also buy stocks based on others' analysis. This can be the friend or colleague or someone that you're following on Facebook or Instagram or Twitter, for example, or the analysis firm or newspaper. Do your own analysis and due diligence before you buy something, and buy only what you can understand yourself. It's not only important to buy at the right time, but also to sell when it's right. If you buy a stock based on someone else's recommendations, the risk is that you don't know when you should sell, because you don't understand how different news from the company can affect the stock price. In fact, research shows that experts only right about half of the time. All analysis and price targets, etc. 50% right. And you should also be aware that people that recommend you to buy a specific stock probably have something to gain from you buying this or following them in some way for their advice. Either they own the stock themselves, or they want you to buy their magazine or subscribe to the newsletter for stock tips. Follow Warren Buffett that proclaims that you should only buy companies that you yourself can understand, and he's been doing pretty well. So, mistake number 3 is to buy stocks without a clear strategy. I often see people that bought a stock and then they ask, should I sell? No one can predict the market and answer this, but with a clear strategy, you will know why you bought a stock in the first place, and then it will be easier to later evaluate if you should keep it longer or sell it. There are many different strategies to follow, and I aim to cover some in later videos, but some like dividend stocks, some like growth stocks, others like index funds, or follow purely mechanical strategies that will signal when you should buy or sell. If you at some point feel that it's hard to watch your portfolio or stock going down, then it can be good to return to this strategy and go through why you decided to buy in the first place. Maybe you will realize that you were actually going to invest long term, maybe during several decades, and that a dip now would not matter that much in the long run. And if you already did buy a stock without a clear strategy and now are wondering what to do, then ask yourself the following questions. Why did I buy the stock in the first place? And did this reason change? You must have bought because you believed in the company for some reason. You can also ask yourself, if you did not already own the company, would you have bought it today? Mistake number 4 is to try to time the market. I know I mentioned this in several previous videos, but I feel like I have to mention it again. I see so many people that sold in the dive in March and then didn't buy in again during the rapid recovery and now are waiting for another downfall. That may or may not happen. No one can predict the market. This is actually one of the mistakes where the small investors lose the most. If a market decline feels too painful, then you're likely investing with too high risk or using the wrong strategy, and you need to rethink this. Don't blindly chase the highest possible returns. Instead, compile a portfolio with a risk level that you can mentally handle at all market conditions and be invested in long term. There is an example of a fund, CGM Focus, that between 2000 and 2010 returned 18% per year, but the average investor in the fund during this period made an 11% loss. How could this happen? Well, the fund was very volatile with huge run-ups and large drops. So after large large drops, investors were panic selling, and when the fund produced great numbers, they were crowding back in again. The most extreme example happened during 2007 when it rose nearly 80%, and then everybody wanted to buy the winner. Then the fund took a great dive in 2008 and returned negative 48%, where everyone then again wanted to sell to prevent losses. Unfortunately, this resulted in the complete opposite and produced losses instead. If they had only stayed invested, they would have gotten 18% per year, and this is a huge return. Mistake number 5 is to buy stocks that has declined a lot, thinking that it surely must be recovering soon. A stock has plunged 99% in a year. Surely it cannot go down further. Yeah, it can. Maybe it will decline to 99.9%. And if you would have bought it when it had fallen only 99%, you would have lost 90% of your investment by the time it hit 99.9%. There's often a good reason when a stock takes a great dive, and this doesn't mean that it has to ever recover. Sometimes it might, especially if the decline was due to a general market movement. But if you find a stock that has declined a lot in a more stable market climate, then you have to take a good look at the company and analyze why the stock has fallen in the first place. If your analysis shows that the decline was unwarranted, then maybe the stock has a greater upside. Maybe. The 6th mistake is to buy penny stocks, especially as a beginner. Penny stocks are stocks that you can buy for $5 or less. And as I mentioned before, one of the mistakes many do is to believe that it's better to buy more shares. And in penny stocks you can buy many for smaller amounts. But there is a reason for the low price of these stocks. These companies often have huge problems. And in fact, these stocks perform much worse than the stock market in general. And on top of that, they are often very volatile. Sure, there might be a slim chance to a greater upside as well, but these stocks might as well plunge 50% or more. Penny stocks are often promoted in different forums on the internet. Maybe you've noticed that there seems to be a new one hyped almost every week. Then you can be sure that the ones promoting them already have bought and are now trying to pump the price up. Lure small investors to buy and raise the price and then dump their stocks only to let the price fall back again. Classic pump and dump, leaving the small investors with losses instead of the fast cash they were hoping for. Mistake number 7 is to keep losers and sell winners. Losses hurt much more than wins feel good. Many start to wonder when they've made maybe a 5 or 10% gain in a stock if it's not time to sell soon to take profits, when they in many cases should have just stayed invested because the stock had more to give. But we're not at all as good at selling when we made a loss, because this is hurtful, and instead we want to wait until the stock turns around again and we at least can break even. In this way we often sell the winners fast and get stuck with the losers, with lots of capital bound over long periods of time that instead would have been able to grow if we just took the loss and bought a stock with more potential instead. And remember that if a stock has fallen with, for example, 50%, then it hasn't fully recovered when it's gained 50% back. To recover from a 50% decline, a stock needs to raise with 100%. And to recover from 90% fall, an increase with 900% is needed. When you realize this, it doesn't feel as likely to get that recovery anymore. Moving on to mistake number 8, which is to average down during losses. Not only do we stick with the losers and sell the winners, but we also buy more of the losers to lower the average price in hopes of getting out at break even earlier if the stock starts moving up again. If you're invested into a blue chip stock and have a long investment horizon, and a temporary drop due to a general stock market movement can be a good time to buy some more. But if you have bought a more volatile stock that plunges, this is just a way to fool yourself. In large downfalls, the risk is that you put more and more money into the loser, and in the end you will get stuck with huge amount of capital in this losing stock. It would have been better to take the loss up front and then maybe, if the fundamentals support it, buy in again at a lower price later. Mistake number 9 is to start day trading. Many people make day trading not only look easy but also very profitable. But the vast majority that start is going to end up losing money. And even the ones that don't lose, most will barely break even. Part of the losses stem from that it's hard to make gains after covering trading costs. And don't forget taxes. But most of it comes from not finding the right stocks or opportunities to trade. Research shows that only 20% even manage to make any gains at all, where most barely break even. And this is mostly due to luck rather than skills. This means 80% doesn't even gain anything but makes losses. And less than 1% of all traders are really skilled and make substantial gains. A lot of people are promoting day trading right now and selling maybe trading tips or courses. Think about it. If they were really skilled traders and made lots of money, why would they have to sell tips and courses? Mistake number 10, and this is absolutely the biggest mistake I see investors do, is to not subscribe to my channel, because then they wouldn't have had to make all of these previous mistakes in the first place. So don't do this mistake yourself. Subscribe Subscribe so you don't miss any upcoming videos, and importantly, hit the little notification bell because otherwise you might not get notified when I post something new even if you are subscribed. Hit the like button to help spread the videos to more people that need to see it. I put a lot of time and work into these videos, so I would really appreciate it. Where are you on your investment journey? Did you just start or have you been investing for a while? Let me know in the comments below. Thank you so much for watching until the end. I really do appreciate it, and see you all next time.